bring in Gabriela Santos, a new chief market strategist for the Americas at JPMorgan Asset Management. There's other, okay, this is out of the way temporarily, and now we can be back to worrying about all the other things that we've been worrying about. And one of them, I think, you know, we can all, none of us live forever. So you can avoid death for a while, but eventually it's coming, right? If you have a soft landing, doesn't mean there's not going to be a recession. Soft landings only last until the next recession, right? So there's still an elevated risk of recession, even if we do hit a soft landing. That's a point you made.
That's right. And today we're releasing our fourth quarter guide to the markets to talk to clients and answer some of their top questions. And the main one we're getting is, can the U.S. avoid a recession forever? And the answer is no. The good news is, it seems to us, the higher odds are for a soft landing over the next 12 months. That doesn't mean there are no recession risks. And we do think they're elevated versus what's normal, about 20% recession odds. That means to us that the third quarter is kind of the high water mark for growth. It's looking like it'll be pretty strong when the print comes out. And from here, we slow down. We see risks building. The shutdown, it seems like we've been avoided at least for 45 days, but we're still talking about this month. We go back to paying student loans. We've got these elevated interest rates. So we do expect a softening in the growth pace, and eventually for a recession to happen, be it 2025 or 2026. And
you point out we're at the sticky phase, maybe, of inflation, where it gets harder, which means, why would anyone think that the Fed, if there isn't a recession, why would they cut rates at anytime soon? That's
actually one where we would say that we would fade these concerns that inflation is sticky around 3%. We actually think the Fed can hit their 2% objective.
Really?
Faster than they think they can. So by the end of next year, they think it'll take them until 2026 to do so. And that's really just because we expect this normalization in spending. That should normalize services prices. And more broadly, there's a lagged effect to come through for rent and for auto-related prices. Remember, 2/3 of Supercore is just auto leases, auto repairs. That's why we're watching the risk of the UAW strike. But if it doesn't expand too much, then you should see those auto prices come down. So ultimately, I think the conversation around the Fed is, certainly a lot has changed around the first rate cut. We no longer expect it to happen in the first quarter, but we do expect it to start by the middle of next year, and most importantly, to be faster than the Fed expects once it begins.
Do you think there's any chance that we go a point higher as far as rate hikes in the next year and a half, 2 years?
So based on our evolution of the data, so a slowdown in growth from the 3Q watermark, inflation coming back to 2%, no, we do not think that is necessary.
Do we stay here or do we go down?
We hope we stay here this year and we don't do an additional hike, but there is a nearly 50% chance that it could happen November, December. But most importantly, we're almost done, and we're really
but higher for longer now.
Rate cuts. I think it's high for longer, not necessarily higher than we already are.
Okay.
And in terms of how high, I think is the more nuanced conversation, right? So when you 5.4% is not sustainable.
No, but when you say you look forward to rate cuts, I mean, what's the scenario have to look like for them to cut rates? You think they're going to be smart and say, hey, we're going to cut before there's really pain because we want to prevent a hard landing? Or I just get the feeling the Fed's not going to want to cut until they are sure there's a need for it, which means that you could be looking at a pretty ugly economy.
I agree. I think based on the latest press conference in September, they basically told us they'd be okay with being behind the curve.
Yeah.
And really what they want to see is inflation coming down and being sure that it is on track to their 2% target before they begin to cut rates. So that means beginning in the middle of next year, not earlier in the year, which we think would make more sense. But it also means if you're late, that you'll have to cut a bit faster than you're actually projecting in the dots.
There's more damage that'll happen in the meantime.
Perhaps. And that's where, for us, one of the main asset allocation questions we get is, why not just stay in cash, right? We've got 5.5% cash rates nearly. And for us, the conversation is that that's a dangerous place to be, having too much cash. And that's especially because yields are forward-looking, right? Looking ahead to that growth slowdown, inflation coming down, the faster rate cuts when they begin. And so we would really look to take opportunity of the 10-year at 4.6% because yields peak around 3 months after the last hike. And we can lock in these yields now, benefit from the price appreciation. You could be talking about double-digit returns from just core fixed income. It's a pretty unique opportunity here.
Yeah. Unless they go higher.
So we think we're pretty much at the high water mark.
Hopefully.
But that they won't come down too much. So we got to keep an eye on when eventually the value's been worn out.
Gabriela,
I'm not buying a home, but what do you think mortgage rates are going to be over the next 2 years? Because I was just with some people who were trying to buy a home.
You're not buying
I'm trying to
another
buy a
home.
home.
You're trying to buy a home.
So I'm very
so what do you
interested.
Think? What do you think?
So if we just think about the 10-year, for example, we think we've mentioned the high water mark of 4.6. But all these discussions about the shutdown and the dysfunction in Congress are important because it means that we're not going to solve this high deficit issue. It means there's a higher term premium. So we really don't think the 10-year comes down too far below 3.75%. So for mortgage rates, maybe they come down 80 basis points, and that's kind of
what it is for a long time.
For a while.
For a while.
Until we perhaps get a recession and then the Fed is forced to cut below neutral.
That's not good news.
I'm certainly not looking forward to that.